April had a question.
Yeah.
Can you take us back to 2018, which was the year that killed best option strategies?
I have taken it back to 2018 and they still have a positive expectancy. It's really bad. One thing I will say about 2018 is that the SPX was much smaller. So we then $1.50 is a different delta. Also with that, I think it was only 2 days a week back then. Three is three.
16 is when it changed.
Yeah. So the other thing with even 2020 and 2021 is like, if I see a drawdown of, so let's say 2022, 2023, and 2024, my max drawdown was 5%. And then in 2018, I had a drawdown of like 9%. Statistically, that actually doesn't worry me because I introduced basically 50% more variance to it because I only traded 3 days a week. So that wasn't as accurate of a capture of it. But going back to that same principle is like, since we're closer delta, we are paying a lot more drag to get in 2018 because of the price of the index. So like just from that fact, I anticipate the premium capture being at least 5%, probably closer to 10% lower. The example I also like to give of that is if we go back to my overnight strategy, where I have long options and short options that are only based on delta, not target premium, no difference in risk to reward in 2018 because those are actually offset. So the pricing was the same, but harnessing it in 2018 basically did not really change. So kind of how I look at it is if I were to trade this trade naked with no stop loss, no slippage, not to see, but just to see if there was like the presence of edge, and I had a 25% premium capture, even if the max drawdown CAGR was terrible, I know that there's edge because it has 25% premium capture with no slippage, no isolation. So if I see that exists in 2018 and that exists in 2022, I can say that this strategy still works because there's edge present there and I'm not manufacturing the edge. The environment just got more efficient in 2020 and 2022 to harness that edge based on getting in and out and management dynamics of the market.